Hey, I hope you're doing well. Happy Easter, everybody. It is April now. The first quarter of the year is done, which is crazy already, but you know what time it is. It's time for the Central Coast market updates. I'm going to switch up the order I do things a little bit just to keep things a little bit interesting. So first, let's talk about median sales price. In the Santa Maria Valley, it jumped from 423 up to 478 from February of last year to February of this year. That is a 13% increase. Again, we're seeing crazy appreciation. This is a very good area to park your money with that sort of appreciation compared to other investment opportunities. In the South San Luis Obispo County area, it went from the mid 645s to 752 in a year. That is, again, February to February, that's a 16% increase year over year on that appreciation. Jumping right into the actives, solds, the absorption rate. The Santa Maria Valley, we saw a 22% decrease in the absorption rate. So the amount of inventory on the market, the amount of time it takes to sell through that inventory decreased by 22%. So last month, we were just under a month's worth of inventory. We're now under 3 weeks worth of inventory, 0.71 weeks. So inventory continues to drop, continues to be good markers for sellers. We keep hearing about people waiting and waiting and waiting because they want to wait for this housing prices to drop. But, we have been in this recession now for a year. And if the housing prices haven't started to drop yet because of the recession caused by the recession, what is going to cause that drop to start happening? I don't see it coming. We are seeing an increase in interest rates, which should, in theory, slow down buyers a bit. I think it will, especially as we start getting up into the 4%. But right now, we're still seeing fast appreciation. We're seeing very low inventory. We're seeing multiple offers on houses. So it's very much still a seller's market, but we do still have those benefits of the low inventory, the low interest rates. Let's talk about active listings. In the Santa Maria Valley, we were down last month, we were at 85, down to 65 this month. Think about that, guys. 150,000 plus people, and we have 65 listings in the whole Santa Maria Valley. This is an interesting stat. Last year, we had 169 in March. That's 2.5 times what we have right now. So very, very low inventory. New listings on the market, just slightly down, 98 last month, down to 93. And the solds doubled this month compared to last month. Now, I think I mentioned last month we did have a lot of pending sales. So last month, we had 63 sold houses in the Santa Maria Valley. We're up to 105 this month. Big increase, but again, we did have a lot of pending sales. So houses that were under contract, they were just waiting to finalize all the paperwork and close escrow. Going over to South San Luis Obispo County, active listings, 179. Last month, we were at 171. And again, we see a similar trend as the Santa Maria Valley. We had 445 active listings last March. I think I've said February a couple times, but we're talking about March. We've had 445 active listings last March. That's over 2 times the amount of active listings that we have now. New listings were slightly up in southern San Luis Obispo County, 175 compared to 159 of last month. And the solds were up pretty significantly as well. 103 last month, up to 186 in March. So we are seeing, again, very low inventory. We are moving into the spring and early summer portion of the year, which typically will show more housing sales. That's typically when the market ramps up, but we never really slowed down. We didn't slow down into winter like we normally see. So it'll be very interesting to see what happens in these next few months, because if you remember now, into March, early April is when everything was really shutting down for the first time with all this coronavirus stuff. So it'll be very interesting to, check out what is going on with the numbers in the next 2-3 months, just to see, how people are reacting to this housing market. So you definitely will want to stick around. You want to come back for the next market updates, because we'll be talking more about the numbers in the current month compared to the numbers in the previous month and even in the previous year, just to see if we can spot any trends and see if we can make any observations based on those numbers. My tip for today, as far as investing goes, I always put a tip or a thing to think about at the end of my videos. It's an interesting concept. With investing, you'll hear a lot of people, a lot of the gurus talk about cash flow. right? Having cash flow with your investments, being able to supplement your income with your cash flow. And you'll hear this from Brad Lee, from Grant Cardone, from all the real estate investing podcasts, but I'm not saying that they're wrong at all. I like those people. I listen to them a lot. But there's another way to think about this as well, and I just want you to consider it. And that is that consider the idea of having two distinct phases in your life as far as your finances go. The first phase being accumulation, and the second phase being the draw, meaning drawing out the money that you've accumulated. Excuse me, there's a piece of fuzz. So why would you do this? Well, accumulation. If you are drawing out your money as you're making it, getting cash flow from your investments, you're going to be doing a couple things. You're going to first be taking from the money that could be growing over more time. And second, you're going to be paying taxes on that money. So what some people will do is have a distinct phase of their life where they're just accumulating wealth. They're building up their net worth so that when it gets time to retire, to stop making money, they're able to have a bigger nest egg to draw from. If you remember in a video in the past, maybe 2-3 months ago, we talked about the rule of 200. The rule of 200 is very simple. You take what you want your monthly income to be, let's say it's $10,000, and you times it by 200. And that is the amount of money you would need in the bank to have a $10,000 paycheck every month at a 6% interest rate. So $10,000 a month, you would need $2 million in the bank to pull out the $10,000 a month. So again, if you have your investments and you're constantly drawing on those investments, you're constantly taking money out to supplement your life, to buy new TVs, PlayStations, cars, boats, whatever it is, you are taking from your ability to grow that nest egg quicker and to get to that point that you need to be. It is going to be different for every person. For some people, $2,000 a month might be fine for retirement. For other people, it's going to be $5,000, $20,000. But that rule of 200 is a good way to figure out how much money you do need in the bank at a relatively conservative number for your cash growing, and being able to pull out that money with no drawdown on your actual nest egg itself. Rule of 200, two phases in life: accumulation versus your drawing phase. Something to think about. Not saying it's the right way, but it is a thing to consider, and it is something that might benefit you going forward. My name is Christian Tiessen. I'm with Hubbell Real Estate. I hope you found this video valuable. If you did, please consider subscribing and liking the video and commenting and checking out all my future and past videos. We will talk to you later.